7 signs that the stock markets are at the top still. The unemployment rate is dancing around 3.6% in recent months. The last time we have this low is before the March 2020 crash from the market top. Number 2, long-term trend is still bullish. Nasdaq, Dow, and S&P 500. All are still above upward sloping 200-week moving average. We haven't even kissed the 200-week moving average yet. Bear in mind we touched it in the 2018 trade war crash. Number 3, the VIX is still below 30. In 2020, the VIX hit over 80. In 2008, the VIX hit close to 90. Stay tuned if you want to know the rest of the 4 signs that we are still at the market top. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back everyone to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these markets, please consider subscribing. It's totally free. And of course, tap the like button if you like what you see in today's video. This video is brought to you by my Patreon. If you are a sweet boy, go to patreon.com/magicalgoddesscheryl to support my work. If you want to be my good boy, apply to write your first book with me. Author of best-selling books, Goddess Cheryl. You will get the encouragement you need to be on your author journey. My good boys always obey. They always do everything I ask of them. They never say no. Number 4, a lot of popular stocks are still traded at a very high valuation, like Tesla, Apple, Chipotle, Mexican Grill, and Costco. Tesla is traded at 100 PE, price to sales ratio of 15, and the majority of their sales are cars. 55% of their cars are made and sold in China. China's manufacturing is experiencing blackouts. Chinese middle class is running to the banks. China's demographic are upside down and it's getting worse. No more innovation in China. Young people are lying flat. China will invade Taiwan. Tesla is only down 19% year to date, with gross margin below 30. Is it still worth $1 trillion? Apple stocks is in the same boat as Tesla in terms of China. The PE is at 25. It was traded around 15 for a long time. It only has 48 billion in cash, 119 billion in debt, but it's worth $2.4 trillion. 1 trillion means 1,000 billion. This is a sign that the market is at the top. Chipotle stock is actually higher in year to date. It's traded at 63 PE, price to sale of 5.9 for a restaurant chain. Next year is only growing 13.7%. It has less than 1 billion in cash, but 3.6 billion in debt. Current ratio is at 1.26 with gross margin below 40. That to me is expensive. Especially the stock was slightly up rather down this year. This is another sign that the market is at the top. Costco stock is traded at 40 PE for a retail business growing at 8.2% next year. Year to date only down 15%. Gross margin at around 12%, pretty low, even though some of the goods sold in Costco are more expensive than the regular grocery stores. Look at the stock chart of cost. It's the most perfect stock chart you can ever find, going straight up higher and higher. The last time it has a 40% drop was at 2008. Maybe that's why it's traded rich, and that's definitely a sign of a market top. Number 5, 3-month yield still below 6-month on today's yield curve. No confirmation warning sign yet. When you look at yield curve recently, this is what you see. You can see 6-month to 1 year has the highest rate or yield, but the 3-month yield is still down. And that's the key. Every time when we have a crisis crash, 3-month yields need to be higher than 6-month and 1-year yield. Check out these signals from the charts. This one is from February 24, 2020. This one, .com crash from October 23rd, 2000. This one, the Great Recession from February 20th, 2007. All these signal dates happened before the actual gut-wrenching waterfall like crashing. We still haven't seen the 3-month signal yet thus far. Number 6, the Fed is still raising the Fed funds rate. The 2-year yield is still going up at the same time. The Fed will raise rates to 5% to get a grip on inflation, Deutsche Bank says. The Federal Reserve will have to raise its policy rate to 5% in order to get a grip on high inflation, according to Deutsche Bank. That defies any hope for a policy pivot in the near future. Shortly after August, inflation clocked in above estimates at 8.3%. Markets priced in expectations of another 75 basis point rate hike from the U.S. central bank next week, causing stocks to notch their largest one-day decline since 2020. Despite the recent jump in market pricing for the Fed funds rate, our analysis therefore points to further upside risk to terminal rate expectations. A team of Deutsche economists warned in a note on Thursday, noting that continued surprises in inflation reports could lead to a terminal rate above 5%. That's largely because inflation still remains well above the Fed's target of 2%, and while other experts have pointed out that prices are falling across the board, job reports show that the labor market is still booming, which Fed officials have interpreted as a sign the economy can withstand further tightening. Powell previously stated that the Feds would keep tightening until the job is done, suggesting the Fed will pursue the neutral policy rate. A rate level is no longer restrictive to the economy before thinking about cuts. But the neutral policy rate is often reached by shooting past the inflation rate, the bank said. A Deutsche analysis of previous inflation cycles showed that the terminal policy rate almost always exceeds the inflation rate in order to ensure sufficient tightening in the economy, regardless if inflation was severe or mild. The economists estimated that the Fed would need 0.25% real neutral Fed funds rate or overshoot to fully catch up with inflation, likely disappointing investors banking on a rare rate cut. In particular, with core PCE inflation now likely staying north of 4.5% through year-end and into early 2023, the terminal Fed funds rate would need to exceed these levels. After accounting for a slightly positive real neutral rate, a terminal rate above 4.5% is likely to be necessary, the bank said. But inflation continues to bust estimates and the labor market remains tight. That could raise the terminal rate above 5%, which would be over double the Fed's range of 2.25% to 2.5%. At this point, we see the risk skewed in the hawkish direction, the bank warned. Other analysts have speculated the U.S. could tip into a recession from prolonged Fed hawkishness, and billionaire investor Ray Dalio this week predicted that hiking rates to 4.5% could lead to a 20% drop in the stock market. The 2-year yield is leading the Fed funds rate higher. Only when the 2-year yield crossed the Fed funds rate over, we could potentially see the bottoming pattern start to form. Number 7, inflation is still peaky at 8.3%, hasn't even slowed down at all. Number 8, the unemployment rate is sitting at 3.7% in August, according to the latest figures released by the Bureau of Labor Statistics. Conventional economic thinking maintains that low unemployment signals economy is robust and prosperous on all fronts. But one powerful sector actually thinks it's a bad thing. Can you guess which sector that is? It's Wall Street. Investors usually balk at the idea of low unemployment because it adds pressure to the Federal Reserve to raise interest rate and make it more expensive to borrow money. Higher interest rates cause government bonds to become more appealing than stocks as a safe investment. Whereas stocks don't have a return, bonds do. Lower the risk for investors. The biggest returns occurred when unemployment was above 7.2%. It was only about 2.8% returns when unemployment stood below 4%. Now you know why the market's at the top. This is my client, Tina Kadish's 7 Steps to Thrive in Life and Business. This is her book, Freedom. And my client, Teddy Eazzy's book, Wicked Pussy Perfume. It's an erotic novel series. And my Champagne Frequency, it is a #1 bestseller. And I really love this day. It was so sunny this day. And All You Need is Love and Dreams, another one of my books. It is a bestseller. This one is a hard copy. This one is a hardcover book. And it's incredible. So order your copy today. Thank you for subscribing to my channel. Thank you for the comments and the likes on my videos. I thank you for being a fan. And I hope you've enjoyed my video today. Bye.